Hello and welcome. In this video, we will look at the different types of mutual funds. Okay, I am in etmoney.com and here I will go to mutual funds and click on explore mutual funds. When I do that, this page loads up and here you can see a lot of categories of mutual funds, and all these categories are subcategories of equity funds. So the main category is equity funds, debt funds and hybrid funds. Under equity funds there are these many classifications or categories. Okay, in this video we will learn about equity funds, and in the future videos we will learn about debt funds and hybrid funds. Okay, now what are equity funds? Equity mutual funds are the ones which invest the money in stocks or shares of various companies. Okay, all the mutual funds under this classification invest the money of people in various stocks and shares only. Alright, they do not invest it anywhere other than stocks or shares of companies. Now, when we say equity funds, we have a lot of sub classifications, and let us learn each one of them. Let us start with sectoral funds. Sectoral funds invest in a particular sector only. For example, here we have sectoral banking. So all the mutual funds in this category invest the money in banking sectors only. For example, let me click on this and this particular page loads up, and it loads up all the mutual funds available in banking sector. Now if I click on Tata Banking and Financial Services Fund, the page of that particular mutual fund will load up, and here I'll go down and click on detailed portfolio analysis. When I click on that, I can see in which companies this mutual fund invests. Okay, so these are the various companies wherein this particular mutual fund is investing. So totally it is investing in 33 companies. Okay, 33 companies stocks. All right, yes. So this is how you can get detail of the mutual fund. I'm not going to go to each and every classification and show you how to do it. You can do this on your own, and you can see the benchmark of this mutual fund is Nifty Financial Services Index or FinNifty Index. Alright, so we have learned what benchmark is in the previous video. Let me go back. Now this is sectoral technology. All the mutual funds in this category invest in technology related companies. Here it is infrastructure related companies. Okay, and then we have thematic mutual funds. Thematic and sectoral are similar. So here thematic energy. So this category mutual funds invest in energy related companies. Okay, or stocks of energy related companies. All right, yes. Now the thing about the sectoral mutual funds is that the risk of the mutual funds will be higher. Now tell me, when do we go for sectoral mutual funds? For example, if I want to go for sectoral mutual fund, when do I go for it? I go for it when I believe that the banking sector will boom in coming years, or if I believe that the banking sector will grow in the next 5, 10, 15, 20 years, then I would be investing in banking sector mutual funds. Okay, so when you are bullish on the sector, you invest in that particular sector. But then there is a huge risk here. That is, if there is a bad news related to banking sector, then the mutual fund will be hit very bad, because the mutual fund consists only of banking stocks, correct? So if there is any bad news related to banking sector, the mutual funds in this sector will take a hard blow. Similar to others also. Infrastructure. I'll buy infrastructure mutual fund only if I believe that infrastructure companies stocks will grow in next 5, 10, 15 years. Okay. But if there are any bad news related to this particular sector, then my mutual funds will take a hit. Alright? Yes. So we have PSU stocks here, and MNC and ESG, environmental, social and governance themes, and much more. We have index funds, which we will talk about in some other video. Now it is not required. Okay. But just remember that the mutual funds of these categories invest in one particular sector only. Banking sector only here. It is technology sector only. No other companies of different sector will be in the mutual funds of this particular category. Okay. Then we have dividend mutual funds. So here mutual funds invest in companies which pay dividend. Alright. So the risk here will be less, because you would be getting dividend money. So even if the stocks fall, the money from the dividend will make up some part of it. Okay. So the risk here is less. So this particular category has mutual funds which invest in companies that pay out dividend. Alright. Next, we have large cap, mid cap and small cap funds. Large cap means market capitalization. Okay. I hope you know what market capitalization is. If not, I have made a video about it and it is on my channel. You can watch it. But large cap means large market capitalization means the top companies of our country. Now this definition of large cap, mid cap, small cap varies from country to country. In our India, the top 100 companies are considered to be large cap companies, and the mutual funds that invest in these companies are here. Okay, let me open this. You see, top 100 companies meaning top biggest 100 companies are large cap companies. Now let me go down here and let me click on Edelweiss large cap fund, and let me go to detailed portfolio analysis. So here you can see number of stocks 76, meaning this particular mutual fund invests in 76 of 100 or top 100 companies. It is not required that the mutual fund should invest in all 100 companies. No. So they can invest in as many as they want. Now this depends on the fund manager. So the fund manager of this particular mutual fund has decided to invest in 76 stocks or 76 companies, and you can see the companies here. Okay. Next, we have mid cap. So after 100, next 150 companies are categorized as mid cap, and the mutual funds that invest in mid cap companies are here. Next, we have small cap. So 100 plus 150, so totally 250, and apart from these 250, whatever companies are there, they are considered to be small cap, and the mutual funds that invest in small cap companies falls here. Okay, or come here. All right. Now coming to risk and what we can say reward. Large cap companies have less risk, less reward. Why? Because large cap companies are already established. They are popular. People know about them. They are stable. Okay. So the price of the stocks vary little here. Okay, they do not go down a lot or come up a lot, they are pretty stable. So they go up slowly, and that is why the risk here is less and also the reward. Next is mid cap. It is riskier than large cap. Here we have medium risk and medium reward. Now these are okay companies. The mid caps of today will be large caps of tomorrow. They are not so stable but not so volatile too. Okay, so here you will get medium risk and medium reward, and the highest risk would be small caps. Small caps are small companies. Today's small cap companies are tomorrow's mid cap companies. Tomorrow's mid cap companies are day after tomorrow's large cap companies. Okay, here the risk and the reward are both high because chance for growing here is large. Okay, chance for growing here is large. So if you are willing to take a risk and you would like to go for lot of profit, then you can go and invest in small cap company mutual funds. Okay, this is not a recommendation, do your own research. All right, next, this is the category where we have mutual funds which invest in both large and mid cap. All right, so the fund manager selects good companies which are large cap and mid cap, and then they invest in that. And then we have index funds, which we will see some other time. Okay, next, here we have multi cap. Multi cap and flexi cap are same or similar. All right, so here the fund manager invests in various market capitalization companies of various sectors. Okay, so it can be mid cap technology, small cap banking, large cap energy, and so on. So here the market capitalization or the sector is not fixed. The fund manager sees where there is a good opportunity and he invests there. Okay, so he can invest in as many companies as he wants and from any sector or market capitalization. Okay, next we have focus mutual funds. So here the fund manager can invest in a maximum of 30 stocks. Okay, 30 companies. This here or the fund manager here is very focused. He focuses only on 30 stocks, and that 30 stocks can be of any sectors or market capitalization. All right, so here we saw the example of 76 stocks in a particular mutual fund. It can be any number. All right, the numbers are not fixed here, but here in focused mutual funds, maximum of 30 would be there. Okay, 30 or less. So here they focus on good companies according to the fund manager. Next, we have value oriented mutual funds. Now what happens is in the market there will be lot of undervalued stocks. Okay, undervalued stocks. There is something called as intrinsic value, and sometimes the stocks will be trading below this value. Okay, the companies here can be popular or not so popular. Okay, the fund manager will be on a lookout to find which stocks are undervalued, and wherever he finds that the stocks are undervalued and will go up in the near future, he would invest in that particular stock. Okay, so here will be the investment in undervalued stocks. Next, we have international mutual funds. If you want to invest in international companies, then you can invest in these mutual funds. Let me open this up and show it to you. So here we have few mutual funds. Let me click on ICICI Prudential US Blue Chip Equity Fund, and let me go to detailed portfolio analysis. And here you can see all the companies: Walt Disney, Salesforce, Raytheon, Elysian, okay, all these US or other country companies. Okay, yeah, so these are all from US. So similarly, if you want to invest in the companies of other country, then you can go for this. Next, we have contra mutual funds. Now, this is very interesting. Here, the fund manager invests in companies which are neglected by the market or the public. Okay, there will be many companies which would be neglected by people, meaning people do not invest or trade in that, or trade very less or invest very less in that. But the fund manager feels that these companies have been neglected, have potential to grow, and are good. And so, what he does is he invests the money in these neglected stocks. Okay, neglected stocks. And if he does that, it falls under the category of contra mutual funds. Okay. Next is equity fund of funds. Now, this I do not feel this makes any sense. Okay, maybe it has some reasons. Okay, maybe it has some reasons. If there is, then it is fine. But what happens here is the mutual funds here, the mutual funds here invest in other mutual funds and not in stocks. So hear this out. This is the routine, or this is the normal procedure of mutual funds. I buy a mutual fund, and the mutual fund invests the money in stocks or bonds or other things. Okay, so that is normal. Fund of funds is I invest in a mutual fund, and that mutual fund invests in other mutual funds and not the stocks directly. And I feel it doesn't make any sense, and I might be wrong too. Okay. Now, what happens is all the charges of the first mutual fund and the second mutual fund comes to you, and all these will be taken by the mutual fund company. Okay. So you know all the charges of mutual funds, correct? So charges of both will be coming here. So if you click on this is a fund of fund. Let me click on this, and let me click on detailed portfolio analysis, and you can not see anything here, because the fund of funds do not invest in any stocks, but they invest in other mutual funds. Okay, so that is about fund of funds. Okay, here everywhere else we invest in mutual fund invests in various stocks. Here we invest in mutual funds, the mutual fund invests in other mutual funds. All right, so that is fund of funds. Next we have ELSS. If you want to show the investment in mutual fund as savings when you are filing for tax returns, then you can go for this. Okay, so here you have all the mutual funds wherein you can show the invested amount as savings while returning your tax. Okay, the one thing about the tax saver funds are that it has a lock-in period of 3 years. Other mutual funds generally do not have lock-in period. Here, for the tax benefit that they give you, they have this lock-in period. Okay, and generally the exit load will be 0. Now, this is ELSS. Here mostly you cannot show the invested amount for savings tax savings. So here you can show it. Next, here you have the funds which are meant for your retirement. Okay. Now, you can invest in any of these for your retirements. It is not that you have to invest only in this. Okay. But then they have categorized it for retirement, and you can invest in the funds in this category for your retirement. Okay. So that is about the different types of equity funds. You have to remember that equity funds invest only in stocks of other companies, and after that you will have to do your own research and you have to analyze before you invest in any of the mutual funds. All right.